Hi everybody, thanks for taking the time to watch this video. I suspect most of you are already familiar with the concept of exchange traded funds, or ETFs. Many of you are familiar with them because they're low-cost investment vehicles. However, they're also very tax efficient. Many people think this tax efficiency stems from the fact that the indices they're linked to are low turnover. That is, they don't buy and sell a lot. However, there's something more. ETFs have a special blessing from the IRS. In fact, this blessing is so important that I regularly say ETFs are the best invention for the taxable investor in the history of investing. That's why many different mutual fund companies are converting their funds over to the exchange traded fund, or ETF, structure. So that tax blessing is what I'm going to discuss in this video. Before I go into this tax blessing, I'm first going to give you a little bit of background. The first piece is on mutual funds. These were invented about 100 years ago, and these were pooled investments that gave investors very simple or very easy access to a diversified portfolio of professionally managed assets. After the Great Depression, various laws were passed that helped protect investors from various misdeeds that might happen when people are managing other people's money. Fast forward about half a century, we have a lot of history to look at performance. We have seen some performance issues with various mutual funds, and we've also seen some conflicts of interest where commissions like 12B1s or pay-to-play schemes, revenue sharing schemes, have motivated brokers to prefer some mutual funds over other mutual funds, even when they knew better mutual funds were available. Some of the performance issues associated with mutual funds gave rise to index funds. These funds didn't try to outperform the indices. Instead, they tried to follow the index, some index like the S&P 500, for example. So these were more passive in nature rather than being active and trying to outperform the market. By following an index, you didn't need a team of analysts to try to find stocks to outperform the index, so that could reduce the cost. Moreover, because you were following an index that didn't buy and sell a lot of different stocks, it could also reduce taxes. One of the companies that I hope a lot of you are already familiar with is Vanguard, that really popularized the notion of index investing. Now, I know that a lot of people conflate the notions of index funds and exchange traded funds, or ETFs. However, there are actually two separate concepts. Exchange traded funds, a lot of them are actually index funds. However, the exchange traded funds refers to the vehicle, sort of the legal entity through which the assets are managed. Now, a lot of these are index funds, but some of these are actually active as well. And like I mentioned at the beginning of this video, one of the big benefits of the exchange traded fund structure is the tax blessing it gets from the IRS. Other companies such as iShares have popularized ETFs and created a wide variety of flavors that can help fit whatever needs investors might have. I should also mention that there are some other products out there that have labels that are very similar to the exchange traded fund. I'm talking about things like exchange traded notes, ETNs, or the more general label, exchange traded products, or ETPs. These are not necessarily the same thing as exchange traded funds, and they are very likely not to have the tax benefit that the exchange traded fund enjoys. So be very careful when choosing what type of investment vehicle you're considering. Now let's dig a little bit deeper and look at the mechanics of what actually happens when you buy a fund. The first example we're going to look at is the mutual fund. Let's say we have a mutual fund that's owned equally by 4 different investors. Now, it isn't like one investor is going to own the Microsoft and the other investor is going to own the Apple. They all have equal ownership. Economically, they split everything 4 ways. Each one owns a little bit of each of the stocks held by the fund. So now what happens when a new 5th investor shows up and wants to buy the same amount of the same fund? He can go tell his broker to put in his order, and this has to be done by about 4 o'clock. Then the mutual fund will get this information, digest it, and figure out how to divvy up the fund by around 5 or 6 o'clock. Then they'll put that new money to work in the morning. So the fund is actually going to be bigger now, but it's going to be split 5 different ways. Now let's have a look at the flip side, when an investor wants to sell or get out of the fund. The money is invested across a variety of different stocks, so the fund is going to have to sell some of those shares to raise the money to give back to that shareholder. Selling shares that have gains in them will trigger capital gains and hence taxes for somebody. In the case of a mutual fund, these capital gains are distributed to the shareholders. It's worth noting that even if nobody wants out of the fund might just want to rebalance some of the portfolio. Capital gains can still be triggered. The main point is that investors in the fund may get tax bills because other investors decided to leave the fund, or if the fund manager just wanted to rebalance the portfolio. In other words, investors are not in control of their own taxes. And that is a major drawback with mutual funds. Let's take a look at an example to get an idea of what I'm talking about. Some of you might have heard of the Sequoia Fund. I think it's the only fund Warren Buffett himself ever personally endorsed. This fund had a long history of impressive performance. However, it made one really large bet on a single stock that went bad. In this individual position, the losses were so bad that it triggered significant losses for the entire fund. Naturally, many investors were disappointed and exited. However, even the loyal investors who stayed in the fund got hit with tax bills. Because of the people leaving the fund had to make redemptions and they had to take profits in many of their long-term holdings. So when you take a step back and think about this, the loyal investors that stayed, first, they got hit with significant losses being in the fund, but then they got hit with a tax bill without even selling the fund. So this is an example of where mutual funds taxation is not in the control of the investors. It can be triggered by other investors leaving the fund or in cases where the fund rebalances the portfolio itself. Now that we have an idea of how the taxes work with mutual funds, let's have a look at ETFs. When it comes to ETFs, what we normally see is how we can buy and sell the ETFs. We can buy and sell them just like we would stocks on an exchange. What we don't see is how the ETFs themselves transact to rebalance their portfolios or create or redeem new shares. In particular, exchange-traded funds typically do the bulk of their trading with entities called authorized participants. More specifically, the type of trading they do is not how we do it or how mutual funds normally do it, where we exchange cash for shares or shares for cash. When exchange-traded funds deal with their authorized participants, they are doing in-kind transactions. In other words, they're exchanging shares of the ETF for baskets of stock rather than having cash involved in the transaction. This in-kind transaction is the key point when it comes to the taxation of ETFs. The IRS does not deem the in-kind transactions as taxable. So even if the ETF is trading baskets of low cost basis stocks and handing them over to their authorized participants, the IRS is not recognizing this as a capital gain. So the ETFs can actually rebalance their portfolios through the creation and redemption process without triggering capital gains. Not only does this avoid capital gains on the transactions with the authorized participants, but it also allows the ETFs to import whenever they're bringing in baskets of stocks and shipping out shares of their exchange-traded fund. It allows them to bring in fresh new stocks with high cost basis. So this keeps the cost basis in the exchange-traded fund portfolio higher so that even when they do need to transact directly with the market, they can trigger minimal, if any, capital gains. I realize this mechanism can be quite technical and confusing. However, the short story is basically that the ETFs can rebalance their portfolios via in-kind transactions that do not trigger capital gains for their investors. What's important for investors to understand is that ETFs enjoy a tax benefit that mutual funds do not, and that gives investors more control over their taxes rather than being at the whim or being vulnerable to what happens with other investors in a fund or when a mutual fund is rebalancing its portfolio. But you don't have to take my word for all of this. Let's have a look at some statistics. The statistics I like to look at for this, to make this point, come from Morningstar. Morningstar has done studies and keeps track of data, and in this table below, they show the median mutual fund and median ETF distributions handed out on a yearly basis between 2016 and 2020. As you can see, the median mutual fund handed out between 1 and 3 to 4% of capital gains distributions to investors, whereas the median ETF distribution were precisely zero. This very clearly illustrates the tax benefit that ETFs have over traditional mutual funds. Morningstar also keeps track of the fees that the mutual funds and ETFs charge. As you can see in this diagram, the mutual funds, the dark blue bars, the fees for those are much higher than the lighter or bright blue bars that represent the ETFs. You can also notice that the lower cost of the ETF options is also exerting a lot of gravity on the mutual funds as they have to lower their costs to compete. So here's a quick summary of the key points as I see them. ETFs are generally low-cost investment vehicles. Most of us already know that. However, ETFs also have a tax advantage that can improve the tax efficiency and tax planning for many investors. In particular, it allows investors more control over their taxes since they're less vulnerable to the rebalancing or redemptions that go on within the funds that they're holding. The taxes that investors do have to worry about with ETFs are when they sell the fund themselves. If they buy the fund and sell it for a profit, they are going to trigger capital gains taxes. However, if they don't sell it and they pass while they're still holding it, it's very possible that the fund receives a step up in basis when their heirs inherit it, at least under current tax law. Thanks again for taking the time to watch this video. I hope it was helpful. If you have any questions or you'd like to get some help with your own financial planning, please get in touch. Just go to my website and click the contact button in the top right corner. Thank you.